You guys know where you are? Problem 51A. Here we go. 258 to 259, right? Powell's Book Warehouse distributes hardcover books to retail stores. So are we the wholesaler or the retailer or the customer? Let me read that again. Powell's Book Warehouse distributes hardcover books to retail stores. We're the wholesaler. So we're that little online place or actual store that, say, a Barnes & Noble would come buy books from. Make sense? Or like the UMM bookstore would come buy books from us. So we're the wholesaler. Who are our customers? Retailers. Are you and I even able to touch Powell Books? No, because we'd be like the retailer's customers. So just, I know that's confusing, and I want you to just put the wholesaler hat on. Are we still selling? Yes. Are we buying from people? I think we are. We'll find out. Yes, we are. We extend credit terms of 210 and 30 to all of our customers. So can we assume none of our customers are going to pay with cash? Because we're going to extend credit terms to all of our customers. At the end of May, Powell's inventory books consisted of books purchased for $1,800. In June, the following merchandising transactions occurred. So going into our month, we had $1,800 worth of inventory to sell to other retailers. They're saying, here's our June transactions. We purchased books on account for $1,600 from Klein Publishers. So that's almost like a wholesaler's wholesaler. Does that make sense? We're buying to turn around and sell to retailers. We purchased these books, $1,600. FOB destination. Free for who? Us. So we're not going to have that little freight bit in there. So Klein is paying for them. We purchased them with terms 210 and 30. Did we buy them with cash? No. The appropriate party also made a cash payment of $50 for freight on this date. Did we have to pay for freight? Nope. So we're not even going to, they tried to trick you there, that you'd need a transaction. So what did we gain if we bought books on account? We got stuff. We got books. What's that called? Inventory for $1,600. No. Is this really going to happen to me right now? Oh my goodness. Oof, okay. There we go. Inventory, $1,600. How'd we pay? On account. When we owe someone, is it AR or AP? AP, $1,600. On the 3rd. We sold books on account to Reading Rainbow. Do you guys watch that show when you're little? Okay. Makes me feel a little bit old, but what was the guy's name? The guy's name, I can picture him. Yeah, okay, I'm off task. Back to accounting here. Sold books on account to Reading Rainbow for $2,500. Okay, when I see the word sold, how many transactions are there? 2, because the stuff goes, and then we have to say, well, the stuff wasn't free, so COGS. Okay, we sold books for $2,500. If they didn't give us cash, so what was our debit? AR. Sales revenue. And that shows the sale. The stuff left the door. The stuff walked out with Reading Rainbow. So is inventory going to be a debit or credit if we lost an asset? If an asset went, it's gone. Is it a debit or credit? Credit. What's our debit because it wasn't free? COGS. How do we know those numbers? They told us. We sold books for 25. Cost of goods was 1440. So we sell, and then this relates to the stuff. Remember, this ends up being a contra revenue account. When all of this gets shuffled onto the income statement, it's going to look like we made 2,500 bucks. But really, we have an offset of 1440 saying you really didn't make $2,500. Your net sales were not $2,500. Your gross profit was not $2,500. So we're already, we've bought something and we've sold something. So do you see now how we have like two camps going on? What's going on in the next one? We received a $100 credit from the books that we returned to Klein. Whew. Okay, so let's go back to June 1st. We bought books. On June 6th, we returned some of them or all of them? Some of them. You're going to see AP go down because normally this has a credit. So if we debit it, that means it's going to go down. Up here, we owed $1,600. Now what do we actually owe? $1,500. So it might not hurt to just draw arrows like what I'm doing here. We had a credit to accounts payable, and now we returned some. You'll also see inventory go down because we don't have it anymore. We returned it. Yes. Yes. Remember, when we're buying, it's all under that inventory camp. Had this been a customer that was returning to us, then it's sales returns and allowances. Yeah. Maybe this would get to be too much of a highlighter mess, but do you think it'd be helpful to highlight what we're buying and what we're selling? Or can you just, I don't know, out here, you know, like maybe that'd be good at the end to highlight what we bought and what we sold. Okay. Let's go on to the 9th then. We paid Klein Publishers in full, less the discount. It's someone we're buying from. Why did we get a discount? Look at the dates. June 1, did we pay within 10 days? What kind of discount are we going to get? 2%. On what? We bought 1,600. We returned 100. So 1,500. Why is AP going down by 1,500, not 1,600? I thought that's what we originally got from them. Because we returned some. Good. Are we going to pay them 1,500? No, we're not. You're going to see inventory occur here. We're paying them to a 2% discount on the 1,500 that we owe. Because this was the original purchase minus the return times 2% discount. What we actually pay them, and don't put it on 2 lines like my answer key is. What we actually pay them is $1,470, but that 30 has to go somewhere because our debits and credits equal. So if I show you the inventory story, we originally bought 1,600, we returned 100. I can physically see that. We also have, in this case, a minus 30 because that was the discount. I didn't see $30 worth of inventory leave. It's just devaluing it. Sometimes it's a plus. What would constitute a plus here that we didn't have to do this time? Freight. We didn't have to pay the shipping. It was FOB shipper. It was free for us. But that's where freight would show up. How are we doing? On the 15th, someone paid us. Well, when someone's paying us, that's one of our customers who bought from us. We received payment in full from Reading Rainbow. Okay, well, let's stop. When did Reading Rainbow buy from us? The 3rd. When did they pay us? Did they hit their discount period? We got cash of the full amount that they owed. I'll change pen colors. Wait a minute, I thought when you pay your bill, you get a discount. So you didn't pay within the discount period. So you'll see AR go down by the full $2,500. No discount. Why? Because it was $210 and $30 and they didn't, or was it $310? No, it was $210. If they bought it on the 3rd and they didn't pay us till the 15th, they missed that 10-day deadline. Do you like it when it's all jumbled like this, or is it harder? It's just a lot. Okay. On the 17th, we're busy selling again. Okay, so sell tells me 2 transactions. We sold books on account to Blanco for $1,800. The COGS was $1,080. Oofta. We're not making very much money here. Not at all. We should have sold them for more. Sold books on account to Blanco. So the sale looks like this. Oh, put on the wrong one. We didn't get cash because it was on account. We see sales revenue as our credit. But then we have to have another transaction regarding the stuff. What's our debit when we sell stuff to offset the money we made? COGS. And the inventory is gone. Contra revenue. So we sold $1,800, but we don't get to keep much because we have $1,080 as a COGS, like the cost to buy that. Selling stuff's still good. All right, we get to go to the next page. We're buying books again. We purchased books on account from Dietz Publishers. Okay. FOB destination. Free for who? Us. Terms 215 and 30. The appropriate party made a cash payment for $50 on the freight. So did we have to pay the freight? We did not. So if we bought books, we're getting inventory. Inventory is going up by $1,500. Did we pay cash for those books? No. We charged it, so when we owe someone, it's accounts payable. Well, what about the freight? It was FOB destination. It was free for us. Woo! On the 24th, we received a payment in full from Blanco. Better go back. On the 17th, we sold the Blanco. On the 24th, we received their full payment. Did they get the discount? Because all of our credit terms when we sell are 210 and 30. So they had, if they bought them on the 17th, they had until the 27th to pay us. They paid us on the 24th. Okay, so when we get money, we have cash in our pocket. Why wasn't it for the full $1,800? Because we gave them a discount. And kind of what Jenna asked earlier, she was asking a question about returns, but this is another one that shows up when you sell. Remember, not everything is masked in inventory. When you sell, there's those 3 contra accounts that offset it. So this is a contra revenue account. It offsets this. That AR paid their bill. So AR goes down. They don't owe us $1,800 anymore. The difference is we gave them a 2% discount because they paid within our discount period. It's not inventory because we were selling it. It's a sales discount. "26th, we paid Dietz in full." Well, when did we buy from Dietz? On the 20th. We're already paying them 6 days later. How long is their discount period? 15 days. Wow. So we easily made their discount period. Do we owe them money anymore? Nope. So that AP will go down. Are we going to pay them $1,500? No, we're going to pay them the difference, $1,500 minus their, or times their 2% discount. We're actually going to only pay them $1,470. But why is this back to inventory when up here the discount was sales discount? Why is it not purchases discount? It's not how it works with inventory. Inventory is all inventory. The difference of in the 24th we're selling, in the 26th we're buying or paying what we bought. Mine goes on to the next page. You guys all roll into one journal entry, right? Isn't it? Or do you have another page too? Okay, yes. Yes, yes. I'll go back to one of my slides that show all of it again, but yes. When we buy inventory, it's all inventory. When we sell inventory, it's all sales, sales discount, sales return, or COGS. Do you guys flip to the next page? Yeah? Okay. We must be selling because I saw 2 transactions. What's going on the next date? Sold books to Ready Bookstore for $1,400. COGS was $850. Finally, we're making a little bit more money here. So when we sell, AR goes up, sales revenue goes up. This is our sale. Then we turn around and say, well, what happened to our stuff? Inventory is gone because we sold it, and cost of goods sold is going to offset that revenue. Oh my gosh, we're almost done. We have one left, right? On the 30th, Ready, who bought from us 2 days ago, returned some books. Two transactions here because we originally sold them. Now they're coming back to us. So we first say, okay, contra revenue. I sold $1,400 worth of books here. $120 came back. AR, you don't owe us that $120 anymore. That's regarding the sale. Then we have to do another transaction regarding the stuff. So whenever there's selling involved, there's one transaction regarding the sale, one transaction regarding the stuff. The stuff comes back, but then that wipes out COGS, because if the stuff came back, now we don't have that cost of goods sold anymore because it's not sold. It came back to us. So this is the transaction regarding the stuff. That's pretty complicated, but maybe you don't think it was so hard. For me, I'd like to just go through and make sure you understand what is regarding buying and what's regarding selling. If you think it's going to look too much like a elementary art project by highlighting everything, maybe just make little dots. But I think let's just color code what we're buying and what we're selling. I'm going to go through and highlight what we bought. We bought something. We returned something we bought. We paid for something we bought. We bought more stuff on the 20th. On the next page, did I miss one? Oh, I must have just missed it on my scrolling. Yes, I didn't scroll far enough. And we paid for what we bought down on the 26th. I think that's everything. I hope I didn't miss one. Because I don't think the second page was anything that we bought. It was more what we sold. Okay. So, assumably, everything else is sold. Does this work? Because I'm holding the pen. Now. So on the 3rd, we sold stuff. On the 15th, we got paid for what we sold. On the 17th, we sold more stuff. And on the 26th, we got paid for what we sold. I think everything that happened on these dates was regarding sales. Oh, we sold more. They returned some. That's it. So I think that little act of color coding, I think, is going to just visually help you, hopefully. On page 259, it says the Deluxe store is located in Midtown Madison. For the past several years, net income has been declining because of suburban shopping centers. At the end of the company's fiscal year, the following accounts appeared in its 2 trial balances. So if you flip to the next page, we've got all these long lists of things. We've got unadjusted and adjusted trial balances. We're going to, of course, be running all from the adjusted. So we're not going to need the unadjusted. We have to think about what's going to show up on the income statement and where. Lightly with a pencil, you can cross off balance sheet and owner's equity accounts because we're not going to do those. Although it says A, prepare a multi-step income statement, journalize the adjusting entries, and journalize the closing entries. We're not doing B and C. And in A, we're only doing the income statement. We're not going to do the other 2. They're important. We just don't have enough room on the test from a points perspective to do all 3. Okay? So let's cross off the ones we don't need on the income statement. So lightly, you can cross these off. AP, AR, you can cross those off. Accumulated depreciation in cash, cross those off. Do we need COGS on an income statement? Yes. Do we need freight out? Yes, because it's like an expense. Cross off to equipment. I see expense, depreciation and insurance expense. Those need to stay. Interest expense and interest revenue. Those are going to be other. Those are going to be in the other section. Because it's not our livelihood. We're not a bank. We're not a bank extending loans and getting paid. It's just that those will be other. Inventory is an asset. You can cross that off. Over on the other one, notes payable, owner's capital, owner's drawing, prepaid insurance. Those all would show up on other statements. I see property tax expense. Leave that one. I see property taxes payable. Cross that one off. And all of the rest we'll need. Oh no, sorry, I missed that one. So at its most simple form, an income statement is revenue minus expenses. We just know that we gotta stop and start again. Okay, and then we even have the bottom section. You have no headings in there at all? Okay, on the test you will. Good. Our first heading will be sales revenue. I think I put it in a highlight so you'd really be able to see it. So sales revenue. Where do we see revenue? Like I only see it, well, I see it twice. I see sales revenue and then I see interest revenue. Remember, interest revenue we're going to put in that other section because we're not a bank. That's not our livelihood. How many revenues then? I really only see one, so you can put that 700,000 way out here. Now, wow, sales revenue of 700,000, that's pretty good. But are we going to chop that up? We are. In fact, the little bio said sales revenue is declining, net income is declining for these little stores because they're putting malls up all over the place. Now we're going to offset this with two contra revenue accounts right away. My answer key puts them over in the right. I would like you to put them in the left. Do you have two columns? Let's use left and right. So we don't need the far left, left and right. Okay, so we've got less. Oh, I know why they put that way over there, because we only have one. What's another one that didn't appear here? Sales discounts didn't show up, but it would. And that's why they put the $8,000 over there. Does that make sense? Had we had two, you would have had a number here and a number here, and then you would have put the total over there. That's why it's that way. We're going to stop. Single rule. 700 minus 8,000 is what's considered net sales. We really can't call it full revenue because we had some stuff returned. What's our next little stopping point? Stuff wasn't free. Minus cost of goods sold. What's the 692 minus 507? Holy moly, we've eaten up a lot of our revenue. What's the number going to be called? What's the heading going to be over here on the left? You guys remember? Gross profit. Could we stop and run that ratio real quick? $185 divided by 692. Someone do that quick on a calculator. Gross profit rate or ratio, 0.23. Did anyone else get 0.23? What? 0.2673. What would that be as a percentage then? 27%. Okay. Or you could think of it as, so 0.2673. They are making 27 cents on every dollar, or $27 on every $100. Ouch. But look at this. Look at their COGS. That is 100% the problem there. Okay, so analytical, that's why we stopped and did that quick. So that's called the gross profit. I use the word ratio, but the book uses the word rate. So that means, I'll just do 27 cents earned on every $1 in sales. It's bad because COGS is really high. So that's the revenue section. Now we're going to move on to the operating expenses. Notice it's not called expenses, it's called operating expenses because it's the expenses that we have associated with operating our business. Other than interest expense, count them up. How many do we have? Remember, freight is one of them. I think we'll use the left column for this. Boy, there's a lot. 1, 2, 3, 4, 5, 6, 7, 8. Because anything with expense and freight out is like expense's cousin. I know that's a lot to write. So we'll do a little recap on Monday, and then I'll give you time to work on B. Does that sound okay? Don't take accounting home.